Good morning. I am here with Miss Julia.Davis. She is a loan officer with guarantee rate. I am going to let her introduce herself, how long she's been in the mortgage industry, because today we are going to talk about FHA loans. So, Julia, introduce yourself.
Good morning or hello, evening, whenever you guys are watching this. My name is Julia Davis. I'm with Guaranteed Rate. I have been a mortgage loan officer for at least 20 years. It has been probably a little bit longer than that. But I love what I do. I love helping families get into homes, whether it's the first time or the second, third, fifth time. And I'm here to help. So let's go.
Okay, Julia, we know in the mortgage industry, everybody talk about the four type of loan, which is FHA, USDA, conventional, and VA. But today we are going to focus on FHA loan. So can you go a little bit over the history of FHA loan? What is the history behind it?
Well, FHA loans, FHA really stands for Federal Housing Administration. It is a loan that is backed by HUD, which is a government loan. Here in the state of Texas, we are in a community property state. So it does follow guidelines that are consistent with community property state, being that if you are a married person, you do have to pull credit for your spouse, regardless of whether that spouse is on the credit on the loan application. So that's one thing that's really important to know, because the debt that's counted for your spouse will also be counted against you when you do your applications. But FHA loans do have, slightly different guidelines than conventional loans. And I think we'll be talking about that a little bit more as we go forward.
Okay. Okay, so you touched something that is very important when you say community state, because every state is different, but we know there is a lot of people that moving out of states. They don't want their spouse to be in the deed of the property. Is there a way to go around it if they don't want the spouse to be on it?
If they're married and they're in the state of Texas and or purchasing in the state of Texas, um, they can talk to the title company about signing certain documentation that will let them know that, yes, I am aware of this transaction, but I do not want to partake or have any ownership interest in the property.
Mhm.
That's a very specific type of transaction. Again, that would be something we'd have to discuss with the title company. But for the majority of the people, the spouse will have to sign on the title.
Okay, so even if they are divorced and the divorce is not final.
If it's not final, they're not divorced.
Oh,
Yep.
that's a hard pill to swallow, because a lot of people divorce, they don't get a loan to each other, and now you are buying property. You mean to tell me that I have to hunt down my ex and get him to sign on that property? That sucks.
Yeah. And you have to pull credit for that person too. So that's
Wow.
a double whammy. So
Oh,
my recommendation to, most people, if you are separated and not legally divorced, is to take care of that first. Make sure that you are in a single status, unmarried, so that you don't find yourself in any legal binds after the fact.
okay. So they can, if there a way they can go and say, you know what, I'm buying this property, he's not part of the property, so that piece of document will be done by the title company. Is that correct?
Yeah. Mhm.
Okay.
And I always get your advice from your attorney too.
Yeah, okay. Perfect. So my next question is, for FHA, what is the least money somebody can put down for FHA?
The down payment amount for FHA loans are 3.5%. So 3.5% of whatever that sales price is, that's the minimum down. They can put more than that if they choose to, but FHA only requires 3.5% down.
Okay. So for that 3.5% down, is they required for like credit score? What's the score has to be?
Guaranteed rate, we have a 600 credit score minimum criteria to qualify. So as long as they're middle score, again, we have three credit agencies,
Mhm.
and as long as the middle of those three are a 600 or above, then they would be able to qualify on, credit wise for an FHA loan.
Okay. Sometimes we have clients that pull up their credit to Credit Karma. is there a difference between those credit agency and Credit Karma?
Oh, absolutely. I love Credit Karma. It gives me a ballpark of what my borrowers have as a credit score, but they're looking at a consumer report.
Okay.
Consumer reports are different than what we pull for a mortgage report. The point system are slightly different. And 90% of the time, I would probably even say 95, the credit score you see on Credit Karma is going to end up being lower when I pull it.
Okay.
So if you're right at that border at a 600 with Credit Karma, more than likely it's less than 600 with me.
Okay. Mm, okay. You say something about putting 3.5% down. So we heard most lender are doing conventional with 3% down. So is it easier to get the FHA compared to conventional loan?
FHAs are easier or slightly easier to get to if you're in the lower credit score range. And the guidelines are a little bit more lenient. So conventional loans, of course, we'll talk about that another time, but they want more history, more established credit,
Okay.
not a lot of derogatory credit. And FHA will forgive you for certain things. One of the things that they are going to look for, no matter which loan type you're looking at, we're going to be looking for bankruptcies. We're going to be looking for late payments within the last 12 months, especially for prior mortgages. If you have a history of late payments over the last 24 months, all those things are taken into consideration. But like I said, with FHA, it's a little bit more lenient than you would find with a conventional loan.
Okay. So maybe we should get back again because you talk about bankruptcy, so we can make a video about bankruptcy and give some
Yeah.
advice for somebody that just filed bankruptcy, what they need to do to get qualified. So my next question is we have a lot of people that have issues with student loan,
Mhm.
and so is the guideline for student loan is still the same? Because there was something in the news about Fed is going to change the law on student loans. So what are the requirements? Can you go over that a little bit?
Yeah. So most people right now, due to COVID, obviously, are still on deferment with the student loans. FHA requires us that regardless if they're in deferment, that shows up as a zero payment on their credit report. And basically what it's telling us is that we have to do 0.5% of the balance of that loan. We have to count that as a payment because at some point, the borrower will be paying
Yeah,
that
yeah,
note.
yeah.
So they did have, at one point, it was 1% of the
Mhm.
loan amount, and they did recently change to 0.5%. So
That's
it
a
does
big
give us a
difference.
little bit of a reprieve.
Yeah, that's a
Um,
big difference. Yeah.
say that again.
I said that's a big difference from one
It
percent.
is a big difference.
Yeah, that's
It is a huge difference. So it allows our borrowers at this point to qualify for a little bit more because the payment amount is not as high as it was before.
yeah. Okay. So let's go over like PMI for FHA. We know a lot of people whenever they hear PMI, they try to run away, say, I don't want to pay PMI. I want conventional. Can you go over that?
Yeah, just a bit. Okay, so if you're not a person who can put 20% down, or if you don't have the credit scores or the credit to qualify for conventional loan, maybe pay off mortgage insurance. Both conventional and FHA loans will have private mortgage insurance. So private mortgage insurance is basically insurance that's placed on the loan by the insurer of the loan. In this case, FHA is backed by HUD, which is Ginnie Mae. And that insurance is placed there in the event that you're defaulting on your loan, that there's insurance for the agency to cover that loan. So with FHA, you do have a monthly amount that you do pay, as well as an upfront mortgage insurance premium. So basically, you're paying for it upfront for a year. And you can, and then of course, you're paying it monthly so that every year the lender can pay for that on your behalf. The upfront mortgage and insurance premium portion is the only closing cost or fee that's actually allowed to be rolled into your loan.
Okay.
So you can definitely, put that inside of the loan, which most of us do because it's an extra charge that the borrower, doesn't have to pay at closing unless they choose to and have the means to do that.
Okay. I was going to ask you if they can finance it. So you already touched on that. So
Yeah.
I just
Yes. FHA loans, by the way, you can never remove private mortgage insurance from an FHA loan. It will stay with the FHA loan for the life of the loan, no matter how much equity you have in the property. So that's important to know. If they are looking at waiving private mortgage insurance,
Mhm.
they would have to refinance at some point to a conventional loan to do that.
Oh, okay. Okay. Understood. So let's talk about the so since you said the FHA they cannot remove the private mortgage insurance. Is there a guideline when you buy the home? Um what I meant to ask is the quality of the home. Is it has to be move-in ready? Because we see a lot of people do flips and they say not FHA approved for certain stress dates. So can you touch that a
Mhm.
bit on that?
Yeah. So yeah, FHA loans do require the home to be move-in ready.
Okay.
And it has to be safe for the borrower. So things like any electrical problems, if the home comes with a stove and it's not functioning, if there's water leaks in the house, anything that can cause a hazard, if there's flooring that's flipped up that somebody could trip and fall on it. Those are minimal things that I'm touching on that could potentially cause problems with the financing for an FHA loan. They want it to be move-in ready, no problems for the borrower to move into. If there are issues, of course, they will flag it on the appraisal.
Mhm.
And then it will be a matter of, who's going to pay to cover that and fix those items.
Well, um, let me. So the home has to be ready. Can they get a remodel like for the FHA? Because I think there is a
Yeah, there's a FHA 203K
yeah.
renovation loan.
Okay, renovations. Okay.
So yeah, they do have those loans for those homes that require a lot of work. So
Mhm.
if there's a lot of renovation needed in the home, there is 203K renovation loan. They do take a little longer
Okay.
because there's a little bit more detail involved. You're going to have to get bids on how much it's going to take to fix the property up.
Okay.
Of course, they're going to estimate the value after closing. But we definitely offer those as well. But FHA does do renovation loans as well.
Okay.
As far as the flips, you mentioned the flips, so let's talk about that for a minute.
Yes.
If we have a lot of investors in our market
Yes.
right now that are purchasing homes, they're renovating them, they're selling them. So basically, FHA does not allow a borrower to purchase a flipped home. Or basically, what it's saying is that the person who bought the home previously
Mhm.
has to have owned that home for a minimum of 90 days.
Okay.
After the 91st day or on the 91st day, then a person that is FHA approved can then put a contract in on that particular house. So when they're looking and shopping for homes and they've seen some that have been renovated and they're beautiful, that's probably a quick question you can ask is, to get your seller or your listing agent, or, talk to your agent like Rose and find out, if that property, has been owned less than 90 days, just so that you don't run into problems at closing.
Okay. Ah, because and I know there is a lot of open door whenever I show to clients they already have it and this home is not FHA approved. So now I understand the reason why.
Mhm.
So what about if somebody want to currently own a home and the loan is an FHA, they wanna get a second home as an investment property. Can they do that or how does that work? How can they go around
Mhm.
about it?
So investment properties, second homes are not allowed by FHA, not in the state of Texas anyway.
Mhm.
So if they are looking for investment properties, that would have to be a conventional loan, or a second, or a different type of loan for that. But FHA does allow you to purchase another home if you are moving because your family size has increased, your family size has decreased, and you've gone to a different area for, a reason that, would qualify like that. But just to purchase another home and you're wanting to rent it out, FHA will not allow that in Texas.
Wow. Even if, let's say if they were getting a duplex and they live in one side and went on the other side.
Oh, yeah, they can do that.
Okay.
So, because if they're living in part of the duplex, that's their primary residence,
Okay.
they can indeed have the second, um, they can do the second portion as income, producing. So yeah, they could do
Yeah,
that.
I understand. Okay. Well, we are not going to take a long time because I know you touch a lot about what the buyers, the consumer has to do in order to get the loan. So what, as a loan officer, you've been in the mortgage industry for 20 plus years. What is the best advice, like in the current market, you can give to a, regardless if it's a first time home buyer, second time buyer, what is the best advice?
I really think the first thing, by far, bar none, hands down, is going to get a pre-approval,
Okay.
because people always think they know what they can qualify for. The guidelines change all the time. And what might have happened or what you qualified for years ago may not be the same guidelines now. So it's best to know, what you're doing as far as what you can qualify for, what your max budget will be, and have your pre-approval ready to go. So making sure you have your income documents ready to go when you talk to your loan officer. That's going to be your 30 days of pay stubs, 2 months of your bank statements, W-2s for the last 2 years. If you're self-employed, have your tax returns prepared for the last 2 years. Have all these to go so that when you get your application, we can approve you quickly and have your pre-approval letter out fast. Because in this market, we're seeing the homes flying off the handle. We're seeing
Yes.
people overbidding on homes, and you want to know how much you can go to, so that if you do get into a situation where you're having to bid against several people, you know how high you can go on that approval to make that work. So definitely having your pre-approval in hand is key, especially to you guys when you're out in the market, because I know that as soon as you put an offer in, it has to have a pre-approval.
Yes.
So, and of course, if you see something you like and you really, think that it can work, put an offer quick, because they're flying off like hotcakes.
You touched something when you say pre-approval. When you check the bank statement, what are you looking for in the bank statement when you receive it
Oh,
from the consumer?
that's a great question, Rose.
Mhm.
Basically, on the bank statements, we're looking for how much money they have in the account, obviously, but we're also looking for large deposits.
Okay.
We're looking for, we everything has to be sourced. We have to know exactly where it comes from when it comes to large deposits. And in this case, a large deposit for FHA is defined as 1% of the sales price or higher. So as an example, if your house is worth or the purchase price is 250,000, we're going to look at all deposits over $2,500 and above. Of course, if you have your payroll checks going into your account as a direct deposit, that's not going to affect you.
Mm-hmm.
But because we can see where it's coming from. But if you decide that you've had cash at home and you throw $3,000 in the bank in cash, that will definitely be an issue. With FHA loans, you can get gift funds. And let's talk about gift funds for just a minute. Gift funds are basically money that you can get from a family member in order to purchase the loan. Now, gift funds can vary. It can be from your company, but it's really more immediate family. Immediate being your mother, brother, father, sister, aunt, uncle. They're a little bit more leery about cousins. If you can, that you have a really good friend, um, you know, then you could probably do it with a friend, but those are harder to prove.
Mm-hmm.
So, again, any questions they have, we'll definitely address them. But We're looking for those large deposits that may cause any issues for them going forward. If a person is looking to purchase in the future and they have cash, I would say put it in the bank way ahead of time. Make sure that it's seasoned for 60 days, meaning that it's been in the bank account. You have two complete where it's not showing
Mhm.
as a large deposit. Um, and prepare yourself ahead of time if that's what you're planning on doing. If you're planning on purchasing, 3-4 months down the road, prepare yourself and put that money in the bank ahead of time so that that doesn't become an issue at all.
Okay. Let's say somebody is a self-employed. For example, we know we have a lot of small business owners.
Mhm.
So and then whenever they get paid cash. For example, someone who come out and cut my yard, and they go and they get those $30, but there is no way to prove them. Will that affect them, or
Mhm.
how do we go about
So
that?
basically, yeah, for self-employed, we're looking at their Schedule C income pretty
Okay.
much.
Okay.
So Schedule C is your profit and loss on your tax returns,
Mm-hmm.
and we're looking to see how much money they have. Uh, they're showing as income on that. Now, there's certain calculations that we do for that page, but pretty much they have to have it reported. So if they're receiving cash and they show that they're not receiving any money, then we have no money to calculate on.
Okay.
So it's important. We all know that nobody likes to pay more taxes than
No.
than they'd
Nobody
like.
wants to take some.
Nobody does. So basically, you're looking at the tax return on your Schedule C. You are looking at deductions. There are certain things that we can add back into your income numbers to help you, to make sure that the income is correct. But again, you got to show something. We have to be able to see some sort of income in order to know that you're going to be able to repay the loan.
Yes.
And that's what we're looking for.
Okay. So one more thing I was going to ask about the gift fund. What if I want, I have, those sugar daddy, they
Let me tell your husband.
outside my husband,
Yeah.
they want to help. Can they help with down payment, or they need to give me the money 60 days prior?
Yeah, let him do it 60 days prior. No sugar daddies on here, honey. It's got to
Yes.
be immediate family.
Well, again, my name is Rose Dunn. I am a realtor in the state of Texas with EXP. I am here with Miss Julia David. Davis, she is a mortgage loan officer. I've been working with her for many, many years, and she's wonderful. So, last question is, if somebody wants to get in touch with you, I will be sure to put your email below the video. But how do they people get in touch with you?
Absolutely. Well, I'm with Guaranteed Rate, so they can definitely look me up there, Julia Davis at Guaranteed Rate. But my phone number is 832 282 9033. 832-282-9033. They can email me at julia.davis@rate.com, and we'll be happy to help you figure out how to get into the new home.
Okay. So, Julia, thank you for today. I appreciate you. Thank you for coming in. So,
Thank
I
you.
will be sure to keep in touch.
Absolutely. We'll see you soon.
All right.